Well, we will begin. It is 6 o'clock Eastern Time on Sunday, March 19th. David Edwards, President of Parent Wealth in New York City, and
Buff Parham and Associates. How are you, David?
very good. I'm not sure if you knew this, but today is the last day of winter.
Hot dog.
Tomorrow is the first day of spring at 5:24. And I think 2 days after that, the days become longer than the nights. And you can see behind me, I have full sun versus
Yes.
most of the winter. It was already dark by now.
The vernal
So,
equinox.
Yeah, the spring equinox. So tonight I'm going to start off with a poem by Rudyard Kipling, which always comes to me, not the whole poem, thankfully, just the first stanza, that comes to me in times like this. And the poem is called If by Rudyard Kipling. If you can keep your head when all about you are losing theirs and blaming it on you, if you can trust yourself when all men doubt you, but make allowance for their doubting too. That is the perfect description of a wealth advisor. Most of the time, I'm just sitting at my desk, keeping an eye on the news, keeping an eye on things, whatever, while my clients happily go about their lives. But every once in a while, something happens in the news, and all of a sudden the clients are riveted to their portfolios and log into their planning portal for the first time in a while, and are very anxious to do things. And gotta take charge, gotta make decisions, gotta buy, gotta sell, gotta do stuff. And that's the moment when someone like me says, no, actually, we don't have to do anything. Because we are prepared for these kind of scenarios to happen all the time. They happen all the time. Yes, there was a financial crisis this past week, nothing like the financial crisis in 2008, 2009, nothing like the financial crisis in 1998 when long-term capital disappeared overnight. Firm run by PhDs and Nobel Prize winners, it was there, it was gone. So I'm going to take a minute or two to recap, or maybe 5 minutes to recap what actually happened last week, and talk about what I think might happen next. And then actually, no, I'll recap last week, and then Buff has a good list of questions that will lead us through the rest of the conversation. So it's been a pretty quiet 5 years for bank failures. In the last 5 years, only 8 banks failed. By comparison, between 2008 and 2011, 440 banks failed. So, bank failure is something we haven't heard about in a while. What has caused stress in the system has been the Federal Reserve Bank, which starting in January 21 began raising rates as we got out of the COVID crisis. It was pretty clear they'd be raising rates for a while. They were very concerned about inflation. And so it would be reasonable for anybody with a modest knowledge of history to say, okay, well, rates are currently 0% on the 2-year treasury. I'm sorry, the rates were 0% on Fed funds, but were 4%, 5% back in 2007. It's reasonable that will target at least 4%, 5%. And when that happens, the entire yield curve rises. So this is the short end of the yield curve. This is my magic ruler from when I used to teach this class at Morgan Stanley back in the 80s. The whole yield curve rises. And this is where you have short-term securities, T-bills maturing in 3, 6, 12 months. This is the middle size of the curve called T-notes, 1 to 5 years. And then out here is the Treasury bond market. That's securities maturing in 15 to 30 years. So as short rates come up, the whole yield curve moves higher in price. I'm sorry, the whole yield curve moves higher in yield. But it has a different effect on prices. So at the short end of the curve, higher rates don't change the value of T-bills at all. They mature at par. In the middle area, where we have a lot of our clients' money invested right now, there is some loss of price as yields go up. At the far end of the curve, there is a lot of movement as prices go up. So last year, for example, the securities in the 3 to 5 year range fell 5%, but out here they fell 15%. And this is the lesson that anybody who goes into a bank credit training program learns on the first week of that training program. Here's number one. I used to teach that at Morgan Stanley back in 1987 when I was the guy teaching the class. I did the class before that, right? Well, the good folks at Silicon Valley Bank somehow forgot that lesson. And even though it was perfectly obvious that rates were going to be rising last year and bond prices would be falling, they took no action to hedge the portfolio that backs up their reserves. So let me explain what reserves are. Every time you put $1 into a bank, the bank lets it out somebody else who deposits back and so on and so forth. And through recycling, you can essentially have infinite amount of funds. So what the Federal Reserve requires is that you keep about 10% of your money in the bank, or deposit with the Federal Reserve, or invest in a portfolio of treasury bonds. So Silicon Valley Bank had an interesting problem of having a lot of money deposited into it from the venture capital firms that used it, and from the companies that were funded by the venture capital firms, but actually didn't have a lot of opportunities to lend it because certain companies don't borrow money. They have the collateral, they don't have any cash flow, they can't borrow money. So Silicon Valley Bank said, well, no worries, we'll just put all this money in long dated treasuries, we'll get 5% on the treasuries, we'll pay out 1% on our deposits, we'll pocket the spread with a lot of money. And that worked great until after a year or so when the value of those bonds was way down. And Silicon Valley Bank was having trouble maintaining its reserves. So they said, well, no worries, we'll just announce that we need money and we'll put out a stock offering and we'll go from there. But then the venture capitalists got a hold of information and said, oh my God, it's the end of the world. You need to pull all your money out right now. I mean, some of these guys had all caps fleets. And so then everybody, in fact, did pull out of their money. And now you have a death spiral. And by Thursday morning, the FDIC, the Federal Depository Insurance Company, stepped in to go to the bank. So last weekend, we wrote, oh yeah, this happens from time to time. And don't worry about the fact that there's a $250,000 cap on FDIC insurance. In the last 70 years, no depositor has lost money in a bank because the FDIC steps in, takes the healthy part of the bank, deposits, transfers to another bank, and then tries to pay off that process by liquidating the bank. So really, what happened to Silicon Valley Bank was of their own error, failure of risk management. I learned last week that the risk manager had retired in April 2022, and his replacement wasn't hired until December 2022. But meanwhile, the president of the bank, his job was to, do risk management, but he was too busy being a tech evangelist. So, so what happened to Silicon Valley Bank was specific to that. Another bank went bankrupt last week, Signature Bank. Signature Bank is an old school New York City bank with historically 3 lines of business. 1, lending to law firms. 2, lending to real estate companies, and 3, lending to to finance taxi medallions. A very old-fashioned business. Well, they want to be with the cool kids, so they decided to get into crypto in a big way and blew themselves up. All right, so that's specific to Signature Bank. There was another bank in the news this past week, Credit Suisse, which is actually a Swiss company, not American, 200 years old. They've been badly managed for decades. Their job as a Swiss bank is to take in flight capital and pay no interest on it and let it out at small rates. But they didn't think that was where the cool kids should be. They thought that should be wealth management. They wanted to get hedge funds in and alternatives and private equity and a whole bunch of other stuff. And all these products were terrible and cost them billions and billions and billions of dollars. And so even though they got a $50 billion cash infusion last week from the Swiss government, the Swiss banking system, they still went out of business effectively over the weekend, and they're going to merge into UBS as a result. And by the way, UBS is not a very healthy bank either, but it's a Swiss bank, it's not an American bank. So everything that happened in the past couple of days was completely predictable, completely foreseeable by both people who study banks and people who work for banks. But now we live in this universe of Twitter, where any idiot at all can put something out on Twitter. It goes viral, it goes all around, and next thing you know, people are pulling out their hair. So I trust myself, speaking of writer killing, because I've been doing this for 40 years, and I've been through so many banking crises you can't believe. And my clients trust me, which is a good thing, because where are we this year? Well, at the start of the year, the S&P 500 was up 6% at the end of January. And then there was some turbulence in February and part of March. And so now we're up 2.4%. To go from up 6% to 2.4%, really not a disaster. Oh, and by the way, my forecast is still 15% by the end of the year. I'm sticking to my forecast. The market is undervalued, earnings are great, the economy is doing terrifically. So not worried about these banks. And Buff, that's a great place to jump into our questions.
So we witnessed the first bank run driven by social media.
Yes.
In light of SVB, the problems of Credit Suisse and Signature, a hard look right now in terms of banking regulations. Should we expect any revisions?
Well, I think that anybody who was tweeting doom and gloom last week should not get their money back.
Mm-hmm.
You know, it's one thing to shout fire in a crowded theater. It's another thing to splash gasoline on the ground, apply to match to it, shout fire, and expect your Hamilton ticket back. No, you don't get your ticket back. The SEC actually just announced that they doubled their cybersecurity division because so much Ponzi schemes, pump and dump schemes. Oh my God, anything you can imagine back in the bad old days is out there times a million. And there are a lot of gullible novice investors who read this stuff and react on it. You know, strangely, Bitcoin soared last week. Went from 20 to 27,000. Because people are like, dude, you can't trust the banking system. You've got to be in Bitcoin. Well, my forecast for Bitcoin is still zero, right? 2 years from now, 3 years from now, it'll be zero. NFTs were nothing. That was all the rage last year. But you know, push comes to shove, you have to be thoughtful about where you get your information from.
Mm-hmm.
And one thing I've talked about a lot recently is the narrative versus data. The narrative versus data, right? So, for example, the narrative at the start of the year was the Fed's raising rates. Well, that guarantees a recession.
Mm-hmm.
And everybody can repeat that narrative for the last 12 months. But the data doesn't support that.
Right.
The data is company revenues at record levels, company earnings at record levels, the US GDP at record levels, the unemployment rate near all-time lows. There are 2 job openings for every 1 person looking for a job right now. 12 million jobs were created in the last 2 years. That is the fastest rate of jobs growth in all American history. So the data doesn't support the narrative. And actually in January, people started to panic about the narrative, and also the stocks went up. But now February, March, oh no, the narrative is back on. The stocks went down. But meanwhile, any client who's got spare cash right now, we are waving it right in and investing it immediately. Because right now the market is reading extreme fear, according to CNN, and that's when we buy stocks. Extreme fear, we're buyers.
Well, also in this aftermath, we've got a Fed expected to raise next week. What are the chances the Fed actually raises rates right after all that's happened?
Yeah. So the Fed has got two mandates. One mandate is to keep inflation under control, and the other is to promote full employment. Well, we got full employment done. that's perfect. So the Fed is willing to raise rates, for quite a while. And I would have said 12 months ago that they would raise rates for about 18 months, which is on par for past cycles, and they would take us to 4 or 5%, which is where we were in 2007. And right now we're at 4.5%. So yeah, we're pretty close. So now I'm still looking at the end of June as being the end of the Fed increases. Where we come to a finish will be interesting. Prior to 10 days ago, I would have said 50 basis points at the meeting next week. Now I'm going to say 25 basis points. The Federal Reserve is like, whoa, if we break too many of these banks, we'll have a really serious recession because so I'm going to say 25 basis points.
Okay.
But they're also going to just keep doing their job, and if they settle at 5.5% at the end of the cycle, that would be reasonable. The thing that's making the Fed's job really hard right now is that there are 3 components, major components of inflation. One of them is the price of labor, which is up sharply because Americans are all upscaling their jobs. The second cost of it is just basic goods and services, food, energy. Well, energy prices are way down right now. The price of oil is lower now than it was before the Russians invaded Ukraine. That's interesting, right? the world swapped around exactly as we said it would, and now we're back to $70 a barrel. The third part of inflation that's really tough to beat is housing. After 2009, U.S. housing construction slammed to a halt for 7 or 8 years, and only just started coming back in recent years, but at a slower pace. So right now we're short 4 million housing units in this country, and what that means is that prices are high. You want to buy. Prices are high if you want to rent, and that is a major component of what's driving inflation right now. And you can't fix it overnight. There's no way of magically creating, apartment buildings, especially in the United States, where so many communities have got NIMBY rules in place that block multifamily housing that's most in demand. So at a certain point, the Fed will level off at 6% and have to accept a higher rate of inflation while these other issues resolve themselves.
Catch up.
There's one other way that we could actually reduce goods demand, and this was from intro macroeconomics, freshman year coming to college. You can raise taxes. So raising interest rates makes it harder for us to borrow, therefore more likely to lay people off, and that inflicts pain on the least paid, least educated blue-collar members of society.
Yeah.
The other way you can reduce demand is by increasing taxes at the other end. And then, people like me have less money to spend on cars or whatever. And that's the way of reducing demand. And the reaction, of course, is that I'm a rich person who can't increase my taxes. And when I'm a poor person, you can't take away my job. But in our society, rich people have lobbyists and poor people don't. So we will probably struggle with higher inflation for a while and higher rates for a while. And then eventually it's going to work itself out.
Well, I think I know where you are on the next one. We're hearing more sentiment regarding a near-term recession. What's your take on that one?
It's still low. The consensus forecast is a 35% chance of a recession in next year.
Yeah.
Okay. Well, I'm more in the 10% chance.
Yeah.
Show
Exactly.
Show me data.
Well, we've got one more coming. It's the debt showdown regarding the debt ceiling. It looks like a game of chicken.
Yeah.
How much is it going to affect the markets? My question.
Well, the market so far is pretty blasé about it. The debt ceiling has been raised, 70, 80 times in the last 100 years.
Mm-hmm.
It was raised 3 times during the Trump administration. Right?
Mm-hmm.
The problem is that you've got the idiot caucus in Congress right now that wants to hold their breath until they get their way. And the way that they want is for us to, cut federal spending by 90% or something like that. And that's just not, showing any knowledge of reality. And I think Biden is playing it really well. He's like, yeah, whatever, guys, I'm here. I'm in the White House. Come by with your budget. You have to talk about it. If not, hey, if you love the economy, it's all on you. Bye. See you in 2024. So what could happen to us if the debt ceiling does not pass? Well, already the Treasury Department has been sort of slow paying vendors and not putting money into the federal pension plan. If the debt ceiling doesn't go through, salaries for 600,000 federal employees stop the next day. Actually, it's more than 600,000. It's more like 1.6 million. Stop the next day, including all of our soldiers and sailors all around the world. Oh, they'll be making some phone calls to their congressman or woman. Also, the Treasury would stop paying interest on Treasury notes, bonds, bills. So that would, you think that this is bad? Well, we'll try this. And we have got a lot of our clients right now in T-bills picking up 4.5% and 5% because, oh my gosh, we haven't seen this kind of returns in 15 years. Not yanking that money out because I know that even if they do not really get something immediately, they will within a couple days, and then we'll be fine after that. It's just discouraging, though. You really feel like in order for Congress, you need to pass a basic, series of tests. And that will never happen, but like every other job in this world, you have to pass tests. Well, we're not passing tests for Congress.
Well, we'll see what happens, right? We're entering the second year of the Russian invasion of Ukraine. No ceasefire, no negotiations, nothing in sight to say it's going to end anytime soon. But I want you to share with you what you told us a year ago about this whole situation.
Mm-hmm. Oh, so a year ago, yeah, it is exactly a year ago. There were four scenarios. Scenario one was that the Russians would overrun Kyiv in a couple days. Didn't happen.
Mm-hmm.
Scenario two would be that there would be a stalemate pretty quickly. It's kind of where we are right now. Scenario three would be that the Ukrainians would push the Russians out completely. And scenario four was that the Russians would go nuclear. So scenario one obviously didn't happen. Scenario two, we're definitely in a stalemate right now. It's a 1,200-mile border between Germany and Ukraine. It looks like your worst scenarios from World War I and World War II. I actually have a client who's 98 years old who's a veteran about Battle of the Bulge. She's like, oh yeah, I remember the days.
God.
It's put my problems in perspective. The Russians spent 50,000 troops to try and move the borderline 50 yards and did not succeed.
No.
Now, the Ukrainians have been training and arming to go the other way. They may have equal problems because 1,200 miles is a lot of terrain. Each side has expended millions of artillery shells. Both sides are running out of artillery shells.
Yep.
The whole West, right? United States, Canada, and Europe can't manufacture artillery shells fast enough. Meanwhile, the Russians are hoping to import artillery shells from North Korea and China. Well, if China got it again, that would be a big problem for us. The most interesting thing that might happen is a sudden move south towards, I think it's called Melitopol, which is a port city on the Sea of Azov, that would cut the highway from Russia proper to Crimea. And simultaneously would put the bridge that goes from Russia to Crimea within artillery range as well. And if that happens, it's possible for the Ukrainians to encircle the entire Russian army in Crimea. They'll be evacuated by boats. There's always still the risk that Putin goes nuclear on this. Right? I never used to worry about this, now I do. But I think the back channels have said to him, I said, Vladdy, the day you go nuclear, the day will go back to the right. And then bigger ways at all times. So I don't think we'll go nuclear. I think this war could go on for 3 or 5 years. That sucks for everybody. It's a humanitarian disaster. It's an act of vandalism, frankly. I mean, if you look at the videos, it looks like Dresden after the firebombing.
Yep.
What does this have to do with our stocks? Nothing at all. The oil markets reconfigure themselves. We got by that. The Europeans figuring out how to get the natural gas thing. We got by that. The Indians and the Chinese have been buying up a lot of goods with Russia, trading stuff back and forth. They don't really care about humanitarian issues. So we'll just have to watch as these two, combatants fight it out for no purpose at all, no reason, until both are exhausted.
Yeah, sadly enough, the world is quote unquote adjusted while that fight goes on.
Yeah.
I must tell you, I have
60 or 70 wars since the end of World War II.
I have fiddled around with GPS rather, and I find it to be both amazing and scary. But do we really understand the implications of widespread usage of AI just yet? Do we really get that?
Yeah, there's AI embedded in everything we do now. Like, yes, ChatGPT gets all the headlines right now, but there's AI and American Express analyzing every time I swipe my Amex card and selling that information. There's AI at Facebook analyzing, everything I do. I don't use Facebook anymore. I don't use Twitter anymore, right?
Yeah.
I don't feel like giving up my time. There's no scenario where I would use TikTok, right? So, now, I was curious about ChatGPT because I'm halfway through writing a book. The book is stalled because I'm trying to edit it. So I was like, well, maybe I could use ChatGPT to edit my book for me. That'd be so cool. So I did an experiment. I said, hey, ChatGPT, write me a 5-paragraph essay on 1984, which was a standard book that we all read in our 10th grade or so, or 9th grade in high school. And we had to write 5-paragraph essays, blah, 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 blah. Intro paragraph, body, conclusion, whatever. And ChatGPT wrote me a 5-paragraph thing. And then I read it, well, let's read it all. And then I fed it into another AI product called Readable that analyzes text. And it scored it as D. So I don't know how practical it would be. Here's a bigger concern though. ChatGPT doesn't have any way. So ChatGPT, I go to it, looks at a huge block of data extracted from the internet, but only up until about 2012.
Right.
ChatGPT has no way of evaluating whether any of that text is true or false, right?
Right.
I mean, out there's tons of stuff about QAnon and democracy, babies, and stuff like that.
Yeah.
ChatGPT will cheerfully put that into an essay because ChatGPT doesn't understand about sourcing.
Right.
For many years, I wondered what was the value of my Hamilton College education in history and math. And my conclusion was that my Hamilton history degree gave me a lifelong bullshit detector. So, I read dozens of highly sourced materials all the time. What I don't read is Twitter, because out of the 10,000 tweets I might read, only one is useful. That's a pretty low, signal to noise ratio. But number two, I don't know who this person is. What are their qualifications? Is it a 12-year-old kid? Right. So, even when we go to Wikipedia, at least you can pull up the footnotes and evaluate the quality of the Wikipedia post on footnotes. ChatGPT has no footnotes. You have no idea what it is. So I'm not saying that it's not out there. It's definitely got valuable applications. I won't be using it anytime soon. I won't be driving a self-driving car anytime soon. Another application of AI.
Yeah. Well, I asked you, I had to do Mary Had a Little Lamb in Shakespeare. It was rather entertaining.
Let's ask our audience if they want to submit any questions via chat.
Let's see what we got here. I think I see one. Hold on.
There's one.
Yeah. How will China's actions and behavior play into world economics?
Yeah. This is where being a history major is fun, because you like to think that we can all get along. And the fact is, the United States has their society, the Chinese have their society, and we think we're better, and they think we're better. And there's going to be a conflict for the next 100 years as a huge top dog. Maybe a year or so ago, I commented that I thought that by 2030, China would be the largest economy in the world. They're going at 6, 8, 10% a year, just hoovering up all the manufacturing of the world. Everything seems going good for them. There was another Asian country that I thought was going to take over the world. Back in the 1980s, the US was in a terrible manufacturing depression. American cars were just awful. Our whole Ohio, Pennsylvania, Indiana, they're all running to the Rust Belt. And the Japanese, beautiful modern cities with monorails and amazing cars, And I actually went to visit Japan for a month in 1986, and I just walked around like this. These people are going to eat us alive. But then it crashed and burned. And the reason why is because push comes to shove, Japan is a very hierarchical society, a very straight society. And the more we get into the modern world, the more you need flexibility. It's like, a football team, very structured, very rigid, right? Yeah. Basketball team, very fluid. I think the basketball team would crush a football team, on the basketball court.
Yeah.
What a madness. So Japan entered a recession around about 1991. It hasn't come out since. And actually, it's a
Frozen.
demographical death spiral. And,
Yep.
you know, they're still out there manufacturing cool stuff, but they're no longer a player on the world stage.
No.
So China was doing pretty well up until 2020 or so, and then got all round up in COVID, the Spanish Apple crisis. They've got a financial crisis going on based on real estate, always a problem. And also they're reaching out to the Russians probably at the worst possible time. So as a result, the growth rate in China has come way down. US companies are either moving their manufacturing to other countries like Thailand, Vietnam, Cambodia, and Bangladesh, or they're resourcing these factories back to the United States. So maybe China will not need as much money, maybe it will take longer. And then also the Chinese are evaluating how we're dealing with Taiwan. The Chinese are evaluating how we're dealing with Russians and Ukraine to see what we would do, you know, if we decided to do a naval invasion of Taiwan. And I think it would be a pretty catastrophic experience for them. You know, you've got 7,000 ships across the Straits of Taiwan there. Well, we've got Americans with cruise missiles and submarines. And so anyway, but we'll never stop this conflict. You know, Russia was the second largest economy in the world after World War II, now they're 20th, and they're going further down in the rankings. And that's why Putin is so frustrated and angry. He wants to, like, you know, it's almost like you see this girl in the bar and she doesn't want you, so then rape her afterward. Whoa, in the parking lot, you know?
Trying to remain relevant.
That's, you know, an unfortunate imagery, but that's it. That's the motivation.
That's all we got.
Got another question came in?
I think so. Hold on. Hasn't the Fed failed at checks on SVB and Signature? And can we not expect more such failures? And, you know, where's the backup and the dollar backup?
So ironically, the Fed 100% did their job on Silicon Valley Bank.
Yeah.
After the financial crisis in 2009, the Federal Reserve created this whole stress test program as part of the Dodd-Frank legislation. And basically what that meant is you have models, and you have to test those models as in, what if inflation goes high? What if interest rates go high? What if GDP goes low? You know, how's your bank going to respond to that? And in 2018, the Trump administration watered down those rules and said, well, only the 15 largest banks have to do that. And Silicon Valley Bank was the 16th largest bank. Now, the Fed was still there last year with just some routine audits and stuff, and had to do some stress testing, and we used the wrong model. Oh, why? Because the woman who was the head risk manager had retired in April 2022, and her replacement did not start working until December 2022. So there was no one running the risk desk for a while, but some should have been more than that. So, you know, I did spend a lot of time last week trying to understand, was this crisis at Silicon Valley Bank specific or general? And it's specific for Silicon Valley, it's specific for Signature, it's specific for Credit Suisse. It's not applicable to the broader thing. There is one more risk to consider. You know, once upon a time, there were like 20 or 30 airlines in this country, and now there are 4.
Right.
And if you're a consumer flying across country, it's not a fun experience because it's virtually a monopoly right now.
No competition.
Well, yeah, there's like, you know, 200 banks in this country, but 75% of the deposits are at 4 banks. JP Morgan Chase, Citibank, Bank of America, and Wells Fargo. And Silicon Valley Bank will be absorbing one of those banks. It's going to be absorbing banks. So we're losing all the smaller and regional banks, which understand local business people and you know, at the local level, and putting these really big banks. In one of those banks has a problem. One of them. So you know, the other thing I had to say about the Fed. In 2008, the Fed, the Treasury, FSC, they were pretty much winging it every single day. I mean, everybody's on 24 hours straight, they've been mad cokes, whatever, trying to stay awake. It seems like they made careful notes of that experience and actually had checklists And so when SVB got in trouble, they didn't wait till the weekend. They just shut it down at 11 o'clock on a Thursday morning and had a plan ready to go by 6 p.m. Before markets open. 6 p.m. Sunday before markets open on Monday. So it seems like they have got plans, checklists, whatever. And so when these banks made no mistakes, well, we're in the pieces. One more question came in.
Yeah, we got one more. It says
This is the last question.
Last question. Back to Russia, China restoring, etc. What do you estimate is the potential downside in profits and earnings for companies that exit China and its cheap labor and have to pay more for their workers?
Great question. The interesting thing about these companies bringing manufacturing back to the United States, they're bringing a lot of machinery, not bringing a lot of people, right? So like Taiwan, for some reason, ended up being the #1 place to manufacture computer chips. Well, that's a big risk to the United States. We're going to have computer chips, so we're bringing those back on shore. But that's all done by automated machines with a handful of highly skilled, highly paid professionals on top. What is interesting is what's happening across the entire economy. You take the lowest paid job. Let's say you're doing childcare in a daycare center. That's the lowest paid job. It's like minimum wage. When you quit that job, you work for Starbucks at 15. Well, the person at Starbucks quits their job and goes to work at something else for $20 an hour. And that person goes up and gets $25 an hour. So the reason why personal income is on the rise, real gains in personal income for the first time in 25 years, is that everybody is just going up the value chain and getting paid more for the same hours. I don't really see that it's going to have a big impact on company earnings and profits, which right now are so fast. We've never seen profits like this ever, And I'm like, yeah, I think it'd be awesome if some of those profits went back to workers or went back to pay taxes. That would take legislation. So that was a great question to end on, and it is 6:38. We're looking at end on time. So everybody, I wish you a happy spring. And let's just check the markets, the pre-market about that. That might be interesting. So the news from overseas today was that Credit Suisse was going to be bought out for $3 billion, which is a 2/3 discount from where it was on Friday. So it's so sad, It's like I always encourage people to not own company stock, because when bad things happen, right? Anyway, right now the markets are looking at opening up 0.5% tomorrow, up 1%. What's been the strongest the last couple of days has been the growth sector, which got clobbered last year. That was a rebound. So anyway, good day, everybody.
Take care.